For the past couple of years, JEPI and JEPQ have been go-to names for income investors such as myself. They have offered a steady 8 to 12% annual yield, monthly payouts, and some downside protection through their covered call strategies. But after closely watching the markets, comparing total returns, and reevaluating my income goals, I made a bold move. I sold all of my positions in JEPI and JEPQ and rotated into a SPYI and QQQI. So first, let's go over what JEPI and JEPQ are. They are the JP Morgan Equity Premium Income ETF, and it is a covered call strategy. JEPI is going to be the S&P 500 index, and JEPQ is going to be the NASDAQ 100 index. And since early 2020, these have been solid performers for income investors. They've been providing between 8 to 12% annual yield, paying out monthly dividends, while also being fairly stable compared to the broader index. And one thing I love about these JP Morgan funds is its very low expense ratio of 0.35% compared to some of the other ETFs in the space, which have much higher expense ratios. Now, SPYI or SPYI is the NEO's S&P 500 high income ETF, and it pays monthly distributions, and it does have a little bit higher expense ratio, almost double that of the JP Morgan funds at 0.68%. But we're also going to be having a higher distribution rate, which is going to be about 4% higher than JEPI. JEPI's dividend yield is currently about 8%, 8 to 8.5%, paying out monthly distributions, while SPYI has a dividend yield of 12.5%. And this ETF has been out for nearly 3 years now, and it's been doing pretty good. Now, even though it says it's negative in total return because this did have an inception price of about $50, so we're down about 0.58% if you bought in at inception. But it's this dividend yield you want to focus on, and it has had great returns since inception. And similarly, SPYI is one of my favorite high income ETFs, and it's actually up in share price. Now, this one is a bit newer. It was released early 2024, but it does have a 2% share price appreciation, while also providing a massive 14% dividend yield, which is very high for this type of ETF. And compared to JEPQ, which is doing pretty good as well, it's been out since mid-2022, and it's up 5.29%. But this distribution rate, the dividend yield, is a little bit lower at 11 to 12%. So we can see that SPYI as well as JEPQ do have higher dividends while also maintaining their same price. And if we compare the total returns, this means that you're reinvesting your dividends. We can see that year to date, JEPI as well as JEPQ are down in total returns even with those dividends reinvested compared to SPYI and QQQI, which are actually positive for the year at 0.71% and 1.47% respectively for SPYI and QQQI. And this is a fantastic return for this type of ETF, which is going to be providing you reliable monthly dividends. Now, of course, it's not going to get you rich like MSTY, which has an insane dividend yield of 92%. But what you're getting with some of these funds is that consistency as well as downside protection, especially since it tracks an overall index such as the S&P 500. So we go back to the total returns. We can see since January of 2024, if we compare the total returns, JEP has a total return of about 6%. JEPQ is going to have a much higher total return of 13%. And for that reason, a lot of people love JEPQ because you're getting much better share price appreciation as well as 10 to 12% dividend yield. But if we take a look at SPYI as well as QQQI, SPYI has a 14.23% return, as well as QQQI 18.80% total return. So SPYI is beating JEPI by a huge margin, as well as QQQI beating JEPQ by about 5%. Now, I've owned all 4 of these ETFs at the same time, but recently I just made the switch from JEPI and JEPQ into SPYI and QQQI, and it also helps consolidate my holdings so I'm not holding 4 of these types of ETFs. And so far I've been really happy with the returns I've been receiving from SPYI and QQQI. Now, why did I move on from these ETFs? Even though JEPI and JEPQ were designed by JP Morgan, delivering consistent monthly income, reduced volatility, as well as low expense ratios, and they've done very well. As we mentioned earlier, it has been underperforming the NEOS funds. So I felt like my money was not working hard enough for me as an income-focused investor. Now, I do have a sizable portion in YieldMax ETFs, such as MSTY, LTY, YMAX, and YMAG, but I always believe it's great to diversify, and ETFs in this space is great diversification, especially since it tracks a broader index. And I'm also a huge fan of the NEOS funds. There's targeted benefits of SPYI strategy. It seeks to distribute high monthly income generated from investing in the constitutes of S&P 500 index, as well as implementing a data-driven call option strategy, which is just fancy words for covered call options on the underlying holdings it has. And just like the JP Morgan funds, it's actively managed. It's also a little bit more tax advantage, as I mentioned, because it does tax loss harvesting opportunities, which are subject to lower 60/40 tax rates. And we also have to mention that both SPYI and QQQI include a portion of their distributions as return of capital. So why does this matter? Return of capital defers taxes to reducing cost basis instead of being taxed immediately, such as ordinary income, which is very good for taxable accounts. I'm holding all of these ETFs in my taxable brokerages. For my Roth IRA and retirement accounts, I do have a little bit of income ETFs from TLT, but those are mostly growth-oriented funds that I'm holding in there, which I'm basically just setting it and forgetting it. But in my taxable brokerage account, which is about $70,000, that is my income-focused account. We do want to mention that the JP Morgan funds are mostly ordinary income, meaning you're going to be paying full tax rates year after year. So in addition to the excellent returns from SPYI and QQQI, they're also going to be more tax efficient, especially for long-term holders. Now don't get me wrong, JPI and JEPQ are great ETFs, and they've received pretty good ratings from Morningstar. I think it's like a bronze, which is a 3-star. But these ETFs are going to be for people who are a little bit more conservative, want a little bit more downside protection, and are a fan of JP Morgan as a company. Now, the people who want the NEOS funds, such as QQQI, are going to be those income-focused investors who want their money working for them a little bit more. Now, as you mentioned earlier, this isn't going to get you a ton of income compared to some synthetic covered call ETFs or even those single ticker ETFs such as MSTY, but you're going to have moderate income. Dividend yield of 14% from QQQI is a very good yield. And if we take a look at the DRIP calculator, $10,000 will grow to $12,000. $10,000 has grown to $12,400 with dividends reinvested since inception, which was January 30th, 2024, which is a little under a year and a half. And 24% total return is an amazing return in just a year and a half. Now, I do believe that there are some better funds out there that you should invest in, such as ULTY, which has had amazing returns ever since it changed from the monthly to the weekly distributions. If we take a look at when it changed from the monthly to weekly, which was around March 13, that has done amazing. We can see it's had very stable NAV, which was the main concern with this ETF, because prior towards that, it actually was going down continuously without any signs of recovery. And the new strategy that they've been doing is they're holding the underlying shares. It's no longer a synthetic covered call strategy, as well as buying some protective puts on their stocks to protect from the downside, while also providing some pretty good distributions week over week, between 8 to 10 cents every single week. And that's also part of the reason why I'm a huge fan of these high income ETFs from NEOS, It holds the underlying shares of the companies. It's not a synthetic, so you're going to have that capital appreciation as well as the high dividends. So for me, selling JEPI and JEPQ was a tough decision because I've been holding them for so long. They've been reliable, safe, and consistent, everything an income investor could ask for, but as my priorities changed, I've wanted higher total returns as well as higher income, and SPYI and QQQI simply offered more of what I wanted. Now, I still think JEPI and JEPQ are great options for many investors, especially those retirees or those with a very low risk tolerance. But for those of us who want bigger monthly checks to optimize our money and more growth, the NEOS funds are worth a serious look.